Bollinger Bands are a volatility type of indicator. Okay, it's showing me how volatile a particular asset is. Okay, now depending on the time frame you're on will also depend on how you form your Bollinger Bands. Okay, but what it's showing me that based on a standard Bollinger Band where you have the midline is this sort of red line of that you're seeing here, that is of a simple moving average. So it's just a simple moving average over a 20 period. Okay, so it's looking back at the last 20 periods, last 20 candles, and it's defining sort of, what's the average price. And do remember it's based on the close of each of those candles. Okay, so it's taking the last 20 candle closes and then dividing that by 20 to work out what should be the average price. If the current price is above the average price, then that's showing you there's more buyers in the market, or more buyers aggressive in the market. Remember, there's always an equal buyer to a seller. But then, yeah, if price is below the band, the moving average in the midline, then that's showing you that there's more aggression by sellers occurring here. Now, what's applied to this average price is a two standard sort of deviation. Okay, two standard deviation, and what that does is that incorporates sort of over 97% of price action. Okay, so 97% price action should stay within the band. 97% of price action should stay within the band. If it falls outside of the band, the probability of it returning within the band should be quite decent, right? It should be good, right? And that's what we're looking to do. We're trading off the upper and the lower band, right? When price reaches the upper band, that's known as it's reached an overbought region, right? And now there may be profit taking, and there may be more sellers stepping in at that point. When it reaches the lower part of the band, that's defined as an oversold region. Okay, so price has reached an oversold region. We can also call it a bargain area, right, where there may be more buyers willing to buy this asset to accumulate this asset because of that bargain price. Okay, and that's what you're going to work out, right? What is something that is expensive that you want to sell? What is something that is cheap that you would like to buy? Okay, and that's what a Bollinger Band trader does. He's looking for those types of scenarios to occur. Now, Bollinger Bands work rather well, much better on the lower time frames, and they work much better in ranging markets. So let's switch down to a 15-minute time frame. Let's hit the refresh. Okay, there we are. Okay, so now we've got a lot more volatility. You can see some price action. It's sort of, we've got this downtrend over here. We have this downtrend that has occurred over here, but we do have sort of the band, covering most of price action. But what I want to do is sort of define it in different regions. Okay, now there will be times where the band will be in a sort of a very sort of non-expansive sort of region. Okay, so what's happening here is the bands are narrowing. They're narrowing because price is not moving to sort of significant highs or significant lows. There's not a lot of volatility in the price action. So when that occurs, when there's little volatility in price action, then the bands begin to narrow. As they narrow, in most cases, once they only stay in that narrow sort of state for a period of time until a breakout occurs. And the breakout, you could say, sort of break off. Maybe let's apply a little box. If you apply a box, where are some of the drawing tools here? Okay, here we are. So looking at sort of this narrow phase, let's say from this high here. From this high, you've got that high, and you've got sort of this region here. This is the box, right? Okay, so this is my region here, right? If I just sort of, look through, and let me just make this much larger, and let's try sort of, okay, so we've got sort of the most recent high, another high there. This is the low. This is the box. You can see the band narrow. Okay, the band is quite narrow there. We're waiting for the breakout to occur in this state of the hair. It might be once we break through this potential low. Not yet. So again, just about, but didn't quite close below sort of that green box yet. Spiked through in the next candle, but again came back. And that's why waiting for the close of a candle is an important confirmation, because it will help you avoid false breakouts like that occurring. And then you have the next candle, which has closed. You might want to wait for one more candle for confirmation. There you go. That's your confirmation that we've got the breakout occurring of this range of a hair. Okay. So that's one way of trading sort of the sort of the Bollinger Band, is waiting for when there's little volume, little volatility occurring, the bands narrow substantially, creating a box. That, this is just a breakout strategy, waiting for the breakout of the high or the low. Yeah, and yeah, that would have carried on. It came back, retraced, and it continued lower and so on and so on. Okay, so that sort of set the trend direction there. Right? That's one way of trading those Bollinger Bands when you have that sort of narrow state occurring. Now there'll be other periods, other times where you won't have sort of a narrow state. You'll have sort of something like this, sort of this price action here. So what I'm saying is the bands widen. They're not narrowing at this point. This is moving lower. That's moving higher. There's a large amount of volume occurring in the market. Okay. Now when that occurs, be very careful buying at the low. Now where you define the low, it's very tricky, because if I now just move that. Let's move up here, right? Now price is pretty much hogging sort of that line, right? So it's, staying and crossing just below the lower band, right? So we're in the oversold territory, but where is the bottom? You don't know. And that's where candlesticks should step in. Candlesticks is the most important part next. And you're looking for, candlesticks to confirm. You've got a strong rejection candle, you've got a bit of a bullish candle, maybe a strong bullish candle, sort of, back above breaking the highs will confirm it, but no, it didn't. Okay, so we just had a pause and another break lower. So we're waiting to get to a level where the market says yes, that might be a very a good region to buy a bargain price. Maybe it's back to these lows. That's why support and resistance levels matter, right? So I might say no, I'm just waiting for price to come back to sort of maybe this region here, and we see the price rejects this level in line with the Bollinger Band confirmation. Okay, doesn't do that. Oh. So now do note how all the way through we've got lower low, lower high, lower low, lower high, lower low, lower high. And now we've got our first higher low. I might look for the next higher high to be formed. And there we go. Well, the next higher high that's come into place. And now that sort of gives you that condition. Okay, now you can sort of look to buy. And that's what you want to be doing. It's looking for these opportunities. And again, you're looking for when it's on the other side of the band. When's the next rejection? Was it? Oh, you might say, oh, that's great rejection. I can have a very tight stop loss, look and take it back to the lows. And you're trading it in that fashion. Okay, and that sort of goes like that. And that's how you can trade it. Trade it from sort of overbought to oversold conditions. These are oversold conditions, those are overbought conditions. You could trade sort of the narrow phase of it. There is a third trading opportunity. I've got 5 minutes. Okay, so there's a third trading opportunity that I would also consider, and that is trading in the direction of where price action is in regards to is it in the upper band or the lower band region, right? So you can see how price has now stayed in this upper band region a number of times. And what you'll often see is, why not trade every time it comes back to retrace to the moving average, hits the moving average, bounces back off the moving average and starts to make a new high. Again, comes back, retests, moves higher. Retest, moves higher. Only when it breaks through something like this, you might say, oh, I'm not sure about this. But do remember, you want a clean sort of test to the moving average. You might want to move down to a lower time frame for that, even, and you're looking for sort of, those types of setups occurring. Have a look at this one here. So this move over here, right? So we've had that. I think this was probably the box sort of thing we did just a few minutes ago, the box breakout. But in this way, assume just focus on the moving average, right? So price is breaking, making new lows. You've entered. You're getting into this trade. It comes back, retest the simple moving average, retest moves simple average, and moves lower. Again, that was one opportunity to sort of add into your position. Comes back down, comes back, retest again. Another opportunity to look to go short. Naturally, at this point, it doesn't really make it equal low or a new low, but this is the kind of stuff that you'll be looking for, and you'll have lots of opportunities to trade this type of strategy throughout the trading day. Look at that one again. Another one, retest of the simple moving average, breaks lower. Again, in this region, breaks lower. This one, broke above. Here's another one, right? So again, breaks lower, retest, another retest, and it continues to move, then it breaks through, right? So when you're looking for that trend drive action that occurs, maybe look at the Bollinger Bands, but I've just shown you 3 ways to trade the Bollinger Bands, right? Whether you want to trade it on the breakout, as I mentioned, whether you want to trade a mean reversion with an overbought and oversold sort of reversal signals, or you want to trade the trend, right? So with all, with one indicator, and if you've got very good candlestick analysis skills, you can apply 3 different types of strategies using this.